Yeah.
Order filled. Check us out.
You know what time it is.
This is a Mighty Soldiers exclusive.
Yeah. Let's get it. Let's get it.
What's up, guys? I'm Andy with Mighty Soldiers Trades, and we are here for basically, guys, we're just talking about what we see in the market right now, just current little market snippets. And today I have a really special guest, and I'm excited. We've had Gianni on here once before, but without further ado, I'm gonna bring Gianni on here. How you doing today? What do you think about this market action, man?
Well, I'm good, Andy. How are you doing?
I'm doing great, and I got I conservatively got a lot of a lot of little day trades in this morning.
Nice.
Nothing big, nothing nothing bigger picture, but I think that I 6-0 this morning, and
Wow.
it's what I'm looking for and what I'm content with. So I told myself, I said, because I saw a couple more setups, and I was like, you know what, I'm tempted to go for it, and I'm like, you know what, I just hold up, man. Just let this sort of let you tell you the story a little bit before you go getting any giving it back, right?
Right. Yeah, absolutely. So, well, what are we seeing in the market right now? So stocks bottomed in October, and we've been rallying ever since. So we're about 3-4 months into this rally now, and that low coincided with the top in the dollar. The dollar peaked at the end of September. So what this says is that the rally that we've experienced in the U.S. share market is one of currency depreciation. It hasn't been the result of net global capital inflows. And we've also seen interest rates come down during that time, more or less. So, it's been a liquidity-driven rally. The Fed's been raising interest rates, taking away the punch bowl, so to speak. But in the last 3 months, we've actually seen liquidity conditions improve. If you look at credit spreads, they've actually narrowed pretty significantly. So if we look at last week's price action, we had a reversal in the dollar, in bonds, and in stock markets. And so that's my big concern now is if interest rates do start to creep back higher, that's going to create global demand for dollars again. And since the rally in the U.S. stock market over the last 3-4 months has unfolded as the dollar has pulled back, can we manage a continuation of this rally in stocks during a dollar rally? And that is possible. A lot of stock market rallies occur simultaneously with a rising dollar, but it does shift the underlying macroeconomic undertone. And that is, can the stock market continue to rally despite an earnings recession, despite a rally in the dollar? If it does so, then I think we're risk on. We'll probably see new all-time highs this year. I think I wouldn't be surprised if we did, but it's going to come all the way down to this interest rate scenario and this dollar potential rebound. So that's what I'm looking at right now, Andy.
I hear a lot of people saying that when looking at the SPY, that okay, we're looking for the reversal today to the downside. And when I look at the 4-hour, I don't see that at all. I think that I would be an idiot to short this. I'm not calling anybody an idiot for their own. I think every trader is different, man. And I've heard people call all types of traders idiots, including me with the 15-second charts or whatever. But I don't mean. But it's just, this is not a signal for me to be shorting this market right now. In fact, this is more of a buy the dip moment for me, and that's what I've been doing this morning.
Well, that you make a good point. So, we have to talk about time horizon. You talk about how all traders are different, and that's because we're all trading on different time horizons. If you're trading for, income, or you're trading for investments, your time horizon is going to be different, and by extension, your risk profile will be. So, we have been seeing higher highs and higher lows. The fact that the S&P took out its high from December, the Dow did not. The Nasdaq did, but the Dow has already taken out its high from August of last year, but the S&P and the Nasdaq have not. So we have a short-term series of higher highs and higher lows, which is a bull trend. And I think the biggest thing here, if we are going to see a pullback, I'm looking for like a 2 to 5 week corrective decline max. And it all depends where we hammer out the low. If we form another higher low that's above the low from December, then that would, in theory, reinforce the short-term bull trend. And then I would look for us to clear resistance, which we still, by the way, haven't done. The resistance zone that I've been watching in the S&P 500 is at in the $40, $50, $4,200 area. And that's actually where the high formed. I've been talking about that price zone for a few months here. And the high on Thursday was 41.95. So we're testing the upper bound of that range. That's the key zone that I want to see cleared. And we're talking about, let's talk about the characteristics of this rally. Over the last 3 weeks, we've seen a lot of the worst performing stocks and sectors over the last year recover the most. Whether it's so it's been a short squeeze, right? But that's how a lot of bull trends begin. The shorts have to unwind. And I think the question now is whether that was just, a 1 to 3 week anomaly. And we're going to see the sectors that have been leading over the last 2 years, namely the inflation trade and stuff like that, basically resume their leadership. Or if has the Fed truly tamed inflation? Are we back into are we in a disinflationary environment? Fed Chair Powell was talking a lot about that last week. And if so, that actually bodes well for the growth in tech segments of the market, which, by the way, comprise as the largest components of the indices. So that is important. So that's why I think I'm really watching this interest rate situation right now, because if rates start to creep back higher, that's going to be a headwind for growth in tech, which have been the leaders in the rally in the last 3 weeks.
When we look at the weekly chart, and I'm sorry, I next time I'll have my TrendSpider charts ready. I went to log in and it had a futures agreement, and I tried to say okay, and it didn't let me in. So, anyways, but when we look at 348.11 on the SPY, that was a that to me, when we see that low there, and then we look and we see that's just a lower shadow, and we held real body at like 356, 357 there. Yeah. And then we recover from there. And then if you like chart patterns at all, we got this thing that looks like an inverse head and shoulders. Yeah. And we're right at a nice little rejection point. And like I said earlier, every single rejection point is also a breakout point. So I'm looking at this market in both ways. I'm looking for both scenarios to play out. And what am I going to do? And like you said, I see that right now we're getting a real body rejection on the weekly. And we could pull down to I'd say like 396, 398. And we've seen those little micro pullbacks before we continue higher time and time again. And when we look at these things, how many times do we look and we say, okay, this is my thesis, it's supposed to go up, and we buy right there. And then what does it do? It does that little micro pullback just enough to get irritating. And you're like, okay, if I could just wait a few.
Yeah, no, I mean, that's why I said I was looking for a 2 to 5 week pullback. I'm with you right there. That's the big support zone for me. I have it a little bit lower, a little bit more flexibility, but it would be even more bullish if it held in that 395 zone that you said. But to me, as long as SPY doesn't close below 380, 390, I do think this is a market where it was more rewarding to be on the long side versus shorting. But like I said, the S&P and the NASDAQ have not taken out their highs from August of last year, whereas the Dow has. So if the dollar starts to recover here, I would make an argument that we're probably going to see the inflation trade start to reassume leadership, and what that means for the characteristics of this rally, I think is profound, because Andy, you understand this. It's not just enough to match the performance of the index. We want to outperform. That's why we're here. I mean, if the S&P is up 10, I want to be up 20 type thing, and it comes down to the sector plays.
Ideally, yes, but I also just want to keep my money, Gianni.
Yeah. Yeah. No, I'm with you.
So one thing I was wondering, for me, when I look at the dollar, I see this as a very predictable area to hold it. And as I said earlier, you always got to look in both directions. So every time we look for it to hold, we got to also think about a breakout and what we're going to do in that scenario. And we're not giving any advice on what to do with your finances here, guys. Like, do not just make trades based on what we're saying here. But I mean, that right here looks like a spot where we could really hold. And what kind of repercussions? What about the yen? Anything with the correlation with the yen?
Well, I think a lot of it is geopolitical too. So I started buying dollars late last week, and then I added to my positions this morning, and I started off by shorting the euro, buying the dollar. Obviously that situation in Ukraine doesn't seem to be abating anytime soon, and capital has a tendency to flee conflict zones. In Asia, you have the situation with Taiwan, and Japan's in the periphery of that. So that's what I think a big theme is if geopolitical tensions do reignite, which is kind of my underlying thesis for a resurgence in the inflationary trade. It sounds crazy because this goes against everything that we traded in the 2010s, Andy. I know you were around for that too. But in the 2010s, a rising dollar was deflationary. But I think the underlying macroeconomic landscape has changed. And I do think that a rising dollar is actually more inflationary now because it has to do with interest rates, and people want higher yielding dollars. It's a more liquid capital market compared to the rest of the world. Why would you buy euros paying nothing when you can get a 2-year treasury bill paying you almost 5%, or like 4 or 5% now? It's like it's a no-brainer trade. So that's what we call the carry trade. That was a popular phrase back in the QE days. But that's what I mean. Like, we're not in QE anymore. I don't think QE is coming back anytime soon. You can't do QE even when you're in a disinflationary economic environment. You can't do QE when inflation's running 5%.
See, I'm just on that note. I'm thinking that I'm looking way down the line for a surprise. That yes, we do come back into it. But also, I got to tell you guys, I got to tell everybody. Back in 2010, that is when I started paper trading Forex. I had absolutely no idea what I was doing. I was reading the news, but wasn't able to understand. I still don't understand some of it, Gianni, but couldn't understand most of what I was going through there. And what I was doing at that time was I was averaging down, and I was trying to make these things work for myself and forcing them. And I think I blew up $1 million paper account. And so that's what I was doing in 2010. But I'm glad that I got to start in it. I'm glad I got to do what I'm doing now and learn what I'm learning, and get to talk to professionals like you. I mean, you come in here and I mean, this is top notch. This is better than CNBC having you join me here. And that pretty much, I think we're in line with each other on what we think the market's going to do, at least in the near term, right?
Yeah, I mean, I still do generally favor the bullish outlook for stocks. And I do think this is a market you want to buy dips unless we break below support at 3,900 in the S&P. At that point, I think there's some bigger issues. But, here's another thing too, and this is a core principle that I have when it comes to markets, is that capital is like matter from science class. It's never created or destroyed. It just flows from one asset class to another. When stocks crash, cash is worth more. So you better be in cash. Your relative wealth is actually going up if you have cash during a stock market crash. And it's the same thing with bonds. Like, when bonds are going down, that money doesn't just disappear. Yeah, there is a loser on the trade, but there is a winner on the trade too. And so if bonds continue their intermediate bear trend, then I do think that it will benefit stocks at some point. And, it does favor the inflation trade segment of the market. It doesn't even have to be energy necessarily, because I wouldn't be surprised if crude oil hit around 65. But if we get back above 82 on crude oil, I'm more bullish. But, industrials, basic materials, I would look for, segments like that, sectors like that to resume leadership. But in the last few weeks, that's not been the case. It's been the growth stocks and all the stuff that was most heavily shorted, the stuff that, the consumer's hurting. We're not going to be spending as much disposable income. Stick to the core.
We lost your audio. Okay, guys, it seems that we have lost Gianni for a moment here. So one thing that I wanted to say real quick is that even though I have a bullish thesis on the market, let me see if I can bring Gianni up again. Okay. Anyways, guys, I think we have some internet issues. That's okay, though. But even though I have a bullish thesis on the market, what I'm also going to consider, and I'm going to keep this in mind, and Gianni, for when you check this later, pretty much I got to keep reminding myself that markets, when they crash, when they pull back, it's sometimes a lot quicker and a lot more accelerated. And there you are.
Sorry about that.
So basically what I was saying, Gianni, is even though I have a bullish thesis on the market right now, I also have to take into consideration my position sizing and how fast a market can decline if it does go into a decline. So for me, I'm playing it a bit safe. I'm trying to keep my stops in there tight and be very very serious about how tight because it happened to me. Just one candle I buy and it hits me so hard that I'm like, man, stop out. It's just this market can get crazy real fast.
Well, I'll give an example of that. I was trading silver quite a bit in January, and it was range bound. I was looking at a rectangle / ascending triangle price pattern, trying to anticipate the breakout, and I just got whipsawed out pretty nasty. So yeah, that you know, you're talking about stop losses, and that I'm still here because I use stops. You know,
Right,
that's
exactly. Yeah, but I mean, my main point though is I just gotta make it clear that, you know, if this thing does turn to the downside, it's done it before. You know, this market has surprised us. We're in a huge surprise right now. I mean, this whole
Yeah.
thing was starting with tech was just a mess, and
Yeah.
so I'm going to keep that in mind. I'm going to remember who I was dealing with as far as who this market is, you know, and just protect my capital and not allow that to happen to me if it does happen. So I'm looking at both sides. I'm protecting to the downside. And I completely agree. I really appreciate you coming on here. We did go a minute over what we were intending to go for here, but Gianni, it's great to see you, and I really look forward to having you back on here.
Pleasure as always, Andy. Thanks for having me, and look forward to next time.
One thing, Gianni, is there any place that we can tell people to go find you?
Yeah, you can find my work at benzinga.com. We do a weekly insider report newsletter, and you can also find me at mmacycles.com as well.
All right. Thanks so much for joining us today, Gianni. Great stuff. I'm going to go back and review this again, and I'm going to review the charts. And we're going to be having, hopefully, guys, John, he's going to go over something that's going to extend and just add to this. So we're gonna have him on shortly as well. But thanks so much, Gianni, and I look forward to seeing you again soon.
Thanks, Andy. Talk soon.
Talk soon. Have a good one.